Welcome back to Vantage. The summer is over, but the sun is still shining. Over the summer, we had two significant events. Firstly, we had a change of government. Secondly, we had the first UK rate cut. We thought it might be interesting to take a look at the UK property market. We're focusing on an investor who might benefit from these two things. Let's go take a look. Welcome back to Vantage. Great to be back after the summer. We're kicking off the current season with a look at the UK property market and an income pair in the property market. Welcome, Henry Butt. Welcome to Vantage.
Thank you for having me on. So my name's Henry Butt. I am the assistant portfolio manager of AEW UK REIT PLC. I'm stepping in this year whilst Laura Elkin, the portfolio manager, is away on maternity leave. Laura's back in February next year. So it's me in the hot seat for the time being. Bit on me and my background. So I trained at Knight Frank as a chartered surveyor.
Yeah.
I was there for about 5 years before joining AEW in the asset management team. And I have now been at AEW for almost 10 years in this January coming. And more recently, I've been working on the portfolio management side of things for AEW, assistant portfolio manager for the last 3 years. As I said, I think my background in the asset management team is a valuable asset to the portfolio, because obviously one of the main sort of focus points of the portfolio is asset management. We really see that as the sort of beating heart of driving returns. And Laura's background is more on the investment side of things.
Okay, and for those not familiar with it, let's go over the fund, its objectives, the USPs that you see within the fund, and the track record you have in terms of returns, dividend records, again, particularly against your peer group.
Yeah, so AEW, what we're really trying to do is focus on high income and actively manage our properties to drive property returns. And we see ourselves as value investors. And by that, it means that we're really looking at the underlying bricks and mortar value of the properties that we buy across all commercial sectors. And if I first like to focus on the income side of things, we're very proud of paying out our 2 pence per quarter dividend now since Q1 2016, which is 35 consecutive quarters. That's 8p per annum. And obviously, a lot of our investors are attracted by the high dividend yield that we pay. And the other important thing is active asset management and unlocking capital upside. So that goes back on the value investment side of things. We are sort of unconstrained by sector, and we will look at properties on a sort of case-by-case basis. Yeah. And so we will be buying anything from cinemas, offices. We've had a high weighting more recently to industrials, retail warehousing, larger blocks of retail on the high street, for example. And when we're buying those assets, we are typically looking for asset management opportunities to add value. And in doing so, we have now had a 5-year annualized 9.6% NAV total return, which coincidentally is 9.6% property total return as well. And just to give you that, over the last year, it's an 8% property total return and a 6.7 NAV total return. So we're really focused on driving the value of our assets through extending leases, planning gain, and moving on rents through rent reviews and stuff like that.
Okay, that's great. And that are the two things that you alluded to. One, the mention of Laura taking maternity leave, and then secondly, just the diversity of what you tend to look at. Keen to understand how you leverage the wider team at AEW for your investment process. And it sounds like you've got a variety of skill set, but also you're looking at quite a large different sort of universe.
Yeah, I mean, AEW is a large investment management company, HQ'd in Boston, in Europe, headquartered in Paris. And our offices are on the 42nd floor at A Bishopsgate over in the city. Yeah. We moved there back in February. We have a dedicated in-house asset management team. That's where I started when I joined AEW. And we also have an investment team. So starting with the investment team, we will sit down with them once a week at least and go through stock selection. So we pride ourselves in really sort of being at the coalface of the UK property market, so we can source the best and investment opportunities out there. And we will be doing that obviously alongside recycling capital and selling properties. So we will do that once or twice a week. We also have obviously an in-house asset management team, which is where I started, as I said, and we have a number of asset managers who you'll be working on certain properties within the portfolio. And then we have the portfolio management team, myself and Laura. We also have George Elliott, who sits in the fund operations team. His title is fund controller. I would say George is properly under the bonnet of the company. He's in charge of all the numbers, and is, a vital resource to what we do. Particularly the reporting side of things, actually, yeah.
Okay. And the philosophy of being unconstrained. I mean, I find that really interesting from a sector perspective, which is, I guess it gives you a sort of relatively wide remit to go out there and search for the best opportunities. Maybe you want to if you can explain, why you believe unconstrained helps, and then perhaps illustrate it a little bit by some of the more recent acquisitions and disposals you've been sort of doing.
Yeah, certainly. So as I said, we look at assets on a case by case basis when we do the stock selection. I think in the UK property market, and actually all property markets, investors tend to follow the herd, and we've seen that more recently with sheds and beds, and particularly in the industrial sector where yields got so sharp, as low as 2%. Obviously, things have moved out since we've had interest rates move out as well. Rather than follow the herd, we will, as I say, look at individual properties. And actually, we can really pick out some great buying opportunities. There'll be lots of investors who will be selling out of a sector because they just don't want to be in that sector and they are missing opportunities. And we feel that that's a really good hunting ground and we will pick up some really exciting assets. And so, like more recently, for example, we bought some offices in Bath. Bath is a cracking location. And actually, in terms of the alternative use play, which is another important part of our philosophy, you could turn those offices, if they don't do as well as you'd hope, into alternative uses, residential, hotel, student. So we're always looking at alternative uses. So I think the sectors are less important because we try to be nimble in terms of the use classes of our assets. And actually more recently, the government has relaxed the use class system, and we've actually benefited from that, particularly in retail, being able to bring in a wider variety of tenants into the retail sector. So as I said, we look at individual assets. I mean, at the moment, someone would say the office market is the most distressed, which it certainly is. But that does not mean that there are exciting opportunities in that sector. In terms of the industrial sector, it has been pricey, but actually when we look at industrial assets, we'll be looking at the underlying land values of those sites. And actually, if you take a metric within our existing portfolio, the average book value of our entire portfolio is at £75 a square foot. If you compare that to what it costs to build a property, £100 plus to build a warehouse or retail warehousing, or £200 plus to build offices or residential, that looks relatively really good value. And obviously that's ignoring the 8% income return you're getting on top of that £75 per square foot bricks and mortar value. Appreciate that's quite technical, but that's how we look at things. We're looking at, yes, these are our tenants, this is the income, but actually what other opportunities are there with this property, which essentially is a commodity, isn't it?
Yeah, you're trying to get the best out of what you have. Now, I started preparing my sort of research for this actually before the summer. And at that time, we'd just come off a year where rates had been rising. I guess things have changed slightly in that we've had one rate cut since then. How does the rate outlook, firstly, how did the rising rate environment sort of impact your outlook? And particularly now, what's your view on rates and how does that impact your outlook?
Well, I think the first thing I'd like to say is that when we were talking about the resourcing within AEW, I failed to mention that we have an in-house debt team as well, which we have benefited from recently, actually. So we had an existing debt facility with RBSI, and we decided to refinance a year earlier because that debt team very much had their finger on the pulse as to what was going on in the debt markets. Yeah. And we have locked in a 5-year, £60 million debt facility at 2.96% up until May 27. So I think that's a very advantageous position to be in currently, given what's been happening with the debt markets. The debt markets have certainly had a huge impact on transactional activity, investments. Yeah. I was looking at a graph the other day, and transaction activity is the lowest it's been since the GFC. So lower than the year Brexit happened, lower than COVID year. So it's, there's been a real slowdown in stock. The expectation is that now we've had this rate cut over the summer, that things will pick up into the autumn and go to winter, when we might see another one or two cuts. I think that is exciting for us, because I think there will be buying opportunities. I think we have been at the bottom of the cycle for quite a long time, and it's been in sort of a U-shaped trough. And I think that as the market gathers momentum, there will be some buying opportunities going forward, certainly. I think in terms of the existing 33 properties within the portfolio, because they are higher up the yield curve and would be considered less prime, their values have been impacted less than a lot of the more prime investments out there. If I mentioned earlier on the industrial market, yields got as low as 2.5–3%. There was a significant move in valuations there, because obviously what was driving the value of those developments and these prime logistics boxes was the cheap cost of debt that developers were obviously using. We were impacted less so when we saw those rates rise.
Okay. And we've touched on a number of things, the value-based approach of buying properties at the right kind of price, getting the best out of those properties, considering alternative uses, the sort of changing sort of rate cycle. If you were to focus, if someone was coming and taking a look and actually sifting through the numbers and looking at the portfolio and thinking about the earnings of the business, what would you identify as a sort of key earnings driver for the year ahead?
So we've got a lot of quite exciting asset management deals going through at the moment, and we've alluded to that in our last two NAV announcements. We have got quite a good sort of healthy cash position, and historically that cash might be allocated towards a couple of small purchases. As I said, there's a lot of asset management activity going on in the portfolio at the moment. We're carrying out refurbishment of 2 industrial units in Runcorn. We're doing an office refurbishment in Queen Square in Bristol. And we also are splitting some upper parts and a ground floor retail unit in Bristol into 2 leisure lettings. So there's a lot of asset management going on at the moment. Obviously, once those units are let, that will be new income to the company, which will drive earnings. If I take the Runcorn example, historically the tenant in the units was paying £6.50, and we would hope to get a rent as high as £8. So that really is an example of us going after the rental growth and the reversion within the portfolio. I alluded to earlier on as well the investment market, and I think it is an exciting time to potentially sell out of some of our properties and crystallize some profits from asset management gains and recycle that into some exciting opportunities. And we've got a very good track record of doing that. We have an average sale price per premium of 36% to what we bought the assets at, and that's off the last 80 properties. So we're very good at doing the asset management, understanding when we maximize the value of our properties, and actually deciding to cash in our chips and go and find new opportunities. And that has been a bit of a theme for the last 18 months, where we've been selling out of lower yielding properties, mostly in the industrial sector, for yields around 6%, and then reinvesting that money into high yielding assets. Net initial yields ranging really between 8 and 10%. And that's what we would hope to be doing over the course of the next 3 to 6 months as well.
Okay, I think that summarizes it really well. The other thing that changed over the summer, or certainly at the start of the summer, was the change in government. And how are you thinking about the new Labour government and how that impacts your outlook for the sector going forwards?
I think looking back, the most impactful government moves in terms of what we do has been on relaxing the planning scheme. I mentioned the EU's class, and we've had a lot of successful asset management at a property in Coventry, where we managed to bring in a wider variety of tenants into what would have been traditionally retail warehousing parks, and bringing in the supermarket and the dentist, and obviously that drives footfall. So I hope that continues, because that will breathe life into our city centres. And obviously permitted development rights, where you can convert offices into other uses. I think that's obviously been very familiar over the years. So long may that continue. But I think in terms of like the new government, I think the most important thing is that we just have some stability and investors feel confidence in the new government. And obviously that will be the catalyst for growth. And, I think having stability and hopefully growth, obviously that will feed naturally into the property market and its performance.
Okay. Finally, I mean, a lot of people who view these programs, do it to educate themselves around the sector. I mean, you touched on the fact that, there'll be 10 years in January for you. And, your own career trajectory was, starting at Knight Frank and then moving through the ranks at AEW. If someone was, inquisitive about the sort of commercial property market, what would you suggest to them about how to learn about the industry? Is there something you'd recommend that they do, read, watch?
Well, I mean, a lot of the real estate advisory firms, the CBREs, the Knight Franks, the JLLs, there's a lot of research online. So they'll to be doing sort of quarterly snapshots across all sectors. So that will give you a really good understanding of what's going on in the UK. Obviously, property markets are quite micro, I mean, sorry. So, reading about the UK property market isn't necessary. It's not going to benefit you if you want to understand about the German property market, even though the themes will be the same.
Yeah.
I mean, if you're a young person, you're looking to get into property, I would be advising people to look for internships in those real estate advisory firms over the summer, in university holidays. And the more common route to property is to becoming a chartered surveyor and sitting your APC. It's known as, so you will start at one of those firms and you will qualify as a chartered surveyor in 2 years. And then obviously many people stay within those firms and advise people like myself on what to do on property, what rents we should be targeting and bringing in new tenants. Other people move client side, as it's called, myself, and go and work for an investment management company or a bank or a landlord, British Land, Landsec, AEW. So yeah, I mean, there's so much information online, but yeah, I think you learn so much actually getting the experience within these companies. So if a young person was looking to sort of understand more, that's what I would prompt them to do.
Henry, it's been a pleasure having you on Vantage. Thank you very much for shedding a light on the UK property market, the commercial property market, and actually how you go about trying to make a difference and generate the returns that you're looking at. Thank you all for watching. If there's any other sector or fund manager you'd like to hear from, let me know and I will try and make that happen. Thanks for watching Vantage.